Ladies and gentlemen, as we move forward in today's conference, we now arrive at a very important and insightful session, one that brings together leaders from banking, fintech, and financial services to share their perspectives on the evolving financial ecosystem. This session will delve into the opportunities and challenges shaping the next phase of fintech and led transformations, where collaboration between traditional financial institutions and new age technology players is becoming more critical than ever. And ladies and gentlemen, I have the privilege of inviting on stage our distinguished moderator, Mr. Vipin V, Managing Director and Partner at Boston Consulting Group. May I invite you, sir, to kindly grace the stage. He's a APAC head of technology in financial institutions with extensive experience in driving large scale digital and technology transformation. He advises leading banks and financial institutions across the region on innovation, fintech integration, and building a future ready, resilient financial ecosystem. Ladies and gentlemen, we are also privileged to have an eminent panel of distinguished leaders. Each of our panelists brings deep expertise and diverse perspectives from across banking, fintech, and financial services, making this a truly power packed session. I have the privilege of inviting Mr. M. N. Srinivasu, co-founder BuildDesk, a pioneer in India's digital payments ecosystem and fintech innovation. I invite Mr. Sabyasachi Goswami, CEO of Parfios. He is a fintech leader driving data-driven innovation and digital transformation in financial services through cutting-edge analytics and decisioning platforms. I invite Mr. Rajiv Agarwal, founder and CEO of Innovity Technologies, who's a fintech entrepreneur leading innovations in digital payments and merchant commerce, enabling seamless and intelligent transaction experiences for businesses and also for consumers alike. And finally, ladies and gentlemen, we welcome on the panel Mr. Arpit Ratan, co founder and head business development of Signzy. So, ladies and gentlemen, I would now request our distinguished moderator from Boston Consulting Group to kindly take over the proceedings and lead this engaging discussion. So, I would request you to kindly conclude in 35 minutes from now. So, you have 35 minutes for the discussions. Over to you, sir.
Good morning, everyone. Once again, a very warm welcome to all of you, all the delegates here, all the panelists, all the other dignitaries on the stage as well as in the forum. Thank you so much for joining us today. Today in the morning presentation, I think both Yash and Jyoti and Mr. Goyal spoke about how India is one of the most vibrant fintech ecosystems globally. Whichever metric you take, whether it is number of fintechs, number of unicorns, whether funding, any metric you take, India will be in the top 5, not in the top 3. Even with this kind of a ecosystem, today if you look at the contribution of fintechs to overall banking revenue, it will be maybe less than 7-8%. 2-3 years back, we had done some research wherein we had published that the Indian fintech ecosystem will basically drive 20% of the banking revenue by 2030. But since then, a lot has changed. If you look at the fintech ecosystem today, it's at a critical juncture where multiple headwinds and tailwinds are playing out. On one front, the funding has dried up relative to, let's say, 4-5 years back. IPOs have become more and more difficult. AI is disrupting every sector or every part of financial ecosystem, wherein there's questions on the moat of the fintechs going forward. In this context, the discussion on what does it take for fintechs to build a more scalable, more profitable, sustainable scale is a very important question. And we have a very diverse set of panelists today who has built fintechs from scratch, who can share their perspective better than anybody else. With that context, let me start with both Sabya and Vasu. Both of you have built or are founders of one of the oldest fintechs in India, and that too profitable fintechs in India. If you look at the last 2-3 years, there have been a lot of focus on bringing profitability to fintechs, partly driven by the investor pressure. The question I have is the profitability driven by uh, temporary cost cuts or lower innovation, lower sales growth, or is there a maturity of the fintech model itself in place, which will basically sustain over the next few years? The reason I'm asking this question is because we don't want to, it's not a trade off between scale and profitability anymore. We need both. So I just wanted to get your perspective in terms of how do you see the fintech market today? Is there a structural change which has happened and the fintech business models have become mature and this profitability will continue or not? Maybe you can start with Sabya and then go to Vasu, if that's okay.
Okay, Vipin, thanks for asking a very, very important and a pertinent question at this point in time. I think it's fair to say that this is a challenge that the industry is seeing. And I would say that the short answer to this is that both exist. The only thing is how the narrative gets played to the outside world is uh, from the same lens, which is not true, while both exist. So let me start with that. And I think what sets a mature organization, mature fintech, from the others, the difference is a couple of them, and I'll try to list few of them at least. One is there is revenue growth and depth, and not just cost decline. That's the first point. By that, what I mean is your revenue per customer growing, or is it just any ad hoc revenue growth? That is one benchmark to look at whether it's a mature fintech and whether it's a truly profitable, scalable fintech versus an ad hoc cost decline mechanism. That's the first. The second being what I have seen in last many years is the growth remained steady and consistent versus a very aggressive growth. Because over years you realize that you can have 1 year of aggressive growth and then down, and then again aggressive growth and then down. Rather than that, if you have a steady growth year on year, it speaks volumes about how your plan and strategies and scale is working. So there is no inconsistency to that. The third, and which is most important to fintech, and the previous guests have spoken on the DIS, is continuous innovation, and not because there is a cost pressure, you stop innovation, which more often than not happens, and which is where your question or the point of deliberation is. So, in a mature organization, you will see pocket of innovation being rerouted to the innovation area where you see the area will compound over years. That's the path that you choose instead of stopping innovation because you have a cost pressure. Maybe from investors, broad, overall ecosystem, but you cannot stop innovation. So that's the core principle for fintech. What I'm saying is you can repurpose the innovation in the area which you feel and see that that will compound over years. The next is when you when you say profit, I lay stress on the quality of profit. If it is very, very focused towards short term, you will see that it is more focused towards area of the cost optimization versus the lines of area which will hold your revenue for a very long run. And by that, the first point I mentioned that it is revenue per customer, but it is also the areas that the companies decide where you would want cost optimization, where you would want productivity gains, and where are the areas you continue to invest because you feel that's an area which everybody feels today AI is very loosely uh, used word AI. I don't understand. For me today, when my people in the company comes, I said, "Are you talking of MVP or production systems?" And most of them do not able to distinguish that, and they said, "No, no, this works." I said, "Where it works?" So I think it's very important to choose areas very carefully. Are we talking of more pleasing the stakeholders by creating MVPs or really value generating revenue models. If we have this 4 or 5 things set out, I think that's what will keep the company going to a profitable and scale. Otherwise, it is short-term pleasing stakeholders.
Thank you, Sabya. I think let me come to you, Vasu. I think BillDesk has been profitable for a long time, and you built it from one of the oldest fintechs, right? What are some of your learnings in terms of how did you make BillDesk profitable in the early days itself?
Yeah. So even before we talk of BillDesk, the earlier part of your question is to what is driving the focus on profitability within the fintech sector. Fintech is a very broad sector, and you might have to want to analyze that in small, little verticals. But if I had to pick one theme that is driving profitability, or that focus towards profitability, not profitability, but the focus towards profitability, it's the fact that there is lack of capital available. That's a simple, harsh truth. I don't think it's a harsh truth. So it's not coming from a sudden awakening or a epiphany that people have had saying, I need to build profitable businesses. It's got compelled because there is no capital available. Having said that, in the first place, if you kind of look back at the last decade, the capital that supported fintech did not sort a different metric, right? It wanted, like Sabya pointed, aggressive growth as a metric to measure. So from anybody building a business, you're obviously looking to cater to stakeholders' interests equal beyond what you want to do. And to an extent that if your capital was fundamentally a function of your ability to show or deliver on growth, and no particular value assigned to profitability, fintechs grew that way. That's the broader theme. I think across you take fintech as a broad umbrella of companies. But what distinguishes companies there and in terms of the sustainability is this. Even within this kind of, let's say, storm, there have been different kinds of companies that within the fintech, which I would say it's more a cultural thing of how you're building business. It comes from that. So entities that came from that perspective have built robust businesses or models that would perhaps sustain. And entities that built because it was opportunistic, I think we'll see how they'll kind of shape up. I think those are two broad answers. That said, if you kind of go one level deeper into service-based companies versus lending companies versus tech companies, again to the point Sabya made, what becomes important is to figure the quality of earnings and quality of profits. Largely driven again by how, let's say, media covers events or how capital looks at performance. Growth as a single metric has been the driver for most reports to most ways people think of it. So you go from one, you have 100% growth. You go to 1100 from 1000, you still have a 10% growth. To me, the measures of value of business finally have been two levels. One is, of course, what in accounting or what in financial sense would talk of as gross margins or contributions. Pretty much everything else can get gamed, even you're building businesses, right? You can build revenue and build your direct costs coming down to an operating level, or defer operating level, don't recognize people costs, bundle them, so various things are possible. I think the one measure that is tough to manage is what is technically what is called the gross margin of the contribution. I think that's always been a good measure to think when we look at partners or companies. That's been a good measure. The second, while percentages matter, I think the absolute pool is what we've tended to look at. To saying, do we grow from 10 to 12? And is that a better way to go there than from 30% to 40%, right? It's cash at the end of the day, absolute pool. Why do I stress on this? This answers the second part of your question is what helped us over the years. In the times we built BillDesk, capital wasn't available easily, nor was it available, let's say, cheaply. It was valued, and every rupee was accountability was sought for. And over that period of building the business for 25 years, that was been the learning that finally when it comes to incurring costs of building businesses, the percentage is actually a secondary metric. It's the absolute that matters. You're paying somebody a salary of, let's say, 50 lakhs. You can tell him at 4 or 8 or 9% growth, doesn't matter, or 20% growth. The incremental 10 lakh. People measure in absolutes. So one of the metrics we've always looked at is what grows absolute pool, irrespective of where it lands as a percentage. And why is that relevant to, I think, fintechs? A lot of fintechs, I think, because growth has been a driver, if you're able to inflate various parameters, you get to higher percentage growths without the pool growing up. So that's been one of the angles. From an industry perspective, I think sustainability versus, as I said, maintainability. Beyond one key factor being the, I think, scarcity of capital, I also think a lot of profitability over the last 2 3 years in many companies, which to begin with philosophically not aligned to profitability, has come through the operating leverage factor. And therefore, why is that important? Because it will play out in the next 3 4 years how sustainable that is. Operating leverage in 2 core counts, people costs and technology costs, because what was rewarded, let's say in the past 5 7 years prior to scarcity, was growth, speed, innovation. 2 factors driving the technology and people inflate, those costs come onto your P&L in a big manner, and therefore those were the focus. Those are easy to kind of take big chunk cuts. The last segment has been, as companies scale and go to IPOs, the discipline forces them to look at things differently, helps you manage marketing costs. The consumer-facing fintechs, which had customer acquisition costs, that's been the other place that they've managed to bring efficiencies.
Yeah, no, I think thanks for that. Also, I think one of the things, at least we have seen across when we look at profitable companies, is the business model by design has to have a roadmap towards profitability. It can't be an afterthought, right? Once you start acquire, like you said, the growth metric can't be growth without any sense of cost or profitability, and then later see that okay, we'll do some cross sell and become profitable, right? So that, I think that point is taken. Let me shift gears from profitability to scale part of it. I think Yash had a page where he spoke about the under penetration in India and the opportunity which is lying ahead. Whether you take retail customers or MSME or insurance, whichever sector you take, we see a large opportunity. Now, maybe I'll request Rajiv and Arpit to speak a bit about where do you see the largest opportunity for fintechs? Like a country in India, there's no dearth of opportunity, but what do you think will be 2 3 opportunities which is worth going after, especially for fintechs, considering your inherent DNA, moat, etc., etc. Maybe we can start with Rajiv and then go to Arpit.
Yeah. Thanks, Vipin. So I think the SMB side is a very interesting area. We have, I think it's one area where in the payment space, business models have been challenging because the cost of acquisition tends to be high, given that there are compliance and regulatory requirements. At the same time, there has been, to add to what Vasu was saying, there has been a lot of infusion of capital into the SMB space, and huge amounts of venture capital into the SMB space, which has led to business models which have not been very well established, and driving a lot of scale out there, and therefore competing with that is also not easy. But over the past about 5 6 years, we have made some judicious calls about entering into the SMB space by trying to first study the real needs at the ground level, and actually try to see how do you construct products, actually I could say craft products, which fit into the flow of the SMB's business. I think that's the place where we have seen there's a lot of value. If you think of product design for an SMB as not a country cousin of an enterprise product, but think of it from first principles up. And if you think of it from first principles up, there are very, very attractive opportunities lying there on the SMB side. So much so that you can not only cover the cost of acquisition, but meaning I'm saying cover the cost of acquisition upfront by charging the SMB for it, rather than trying to defray it over a period of a year and making an assumption that okay, your contribution margin over a year will be able to manage that. You actually upfront charge for the cost of meaning to cover the cost of acquisition. But more importantly, you are able to genuinely make a difference to them, to their business, and therefore actually add value to them and make some reasonable money out of it. I think the challenge there is in product design, if you ask me. And I think that's the area where lesser innovation has happened. Much more innovation has actually happened, in the periphery around it, in terms of just reduce the cost, make the distribution better, go ahead and try to do it through the banking channels, etc. But that's what our belief is. Like today, we have a product which specifically targets SMB businesses, and we are able to acquire between 5,000 to 7,000 SMBs on a monthly basis, while covering the cost of acquisition within the month, without actually having to spend even 1 rupee on doing that. So I think it's possible. Product design is where I would put the stress on, and it's possible to build good, highly profitable, scaled businesses out there. But again, the core principles, I think what Sabir was saying is each customer has to be profitable. You have to stay with the customer. You have to make sure that he's provided the same service levels as you would have provided an enterprise customer, but with the fitting into the economics of that customer, because you're probably earning only maybe 150 rupees a month from that customer versus say 1.5 lakh rupees from an enterprise customer. So how do you make that make the service cost pay for that? And that's where the productivity pieces, I think Yashraj was talking about, are very, very useful things, because that's where those things come. Meaning, how do you make each and every of those processes work at that scale for the cost that's available to you, by transforming that entire piece, not just units of it. So that's my take on it, that I think it's possible. Needs to be thought of from first principles, ground up. Don't look at it as, okay, here's an enterprise product, let me cut it down, remove the frills and make it for an SMB. That's not fair.
And Raju, I'm going to push you a bit on that. When you say SME is a large opportunity, nobody disagrees with that. Where do you see the largest opportunity? Is it in lending? Do you see it in value-added service, offering value-added services so that their business itself can be reimagined? Or is it insurance? Where do you see the largest opportunity today?
I can speak only from the space that we operate in. So we operate primarily in helping them accept payments. And then, of course, you look at things around it. So in accepting payments, I'll illustrate this with an example. One of the very simple issue the SMB faces is that, unlike an enterprise, he is the CIO, CFO, CMO of his little shop. He is multiplexing throughout the day, meaning in the morning he wakes up, some distributor is called up, your payment is pending. He has just handled that, and then suddenly his staff says, I've gone to village because something else has happened. He doesn't know who's going to open the shop. There's a lot of chaos in his life, and that's true. It's very, very different from a regular enterprise situation. Now, within this, the reality is cash flow for him. His life runs on cash flow. He has no VC knocking on his door saying, take a check out there. He has to manage with whatever money is lying in his bank, whatever money is going to come in the day. If you can give him an ability to access cash instantly when he needs it, even based on underwriting his own settlements, but instantly. And believe me, I speak to banks about this, and every bank says that no, it's not possible. I say it's already secure, because settlement is already secured, is going to come next day. But design it in a manner that it is instantly accessible. He is ready to pay to you a fee which is not the interest rate, but a convenience fee. Because what you're doing is removing that anxiety, that angst that he has at that point in time, which is significantly valuable to him. So you can call it as a value-added service, you can call it as a loan, whatever it is, but the kind of margin that you can charge on that is very significant out there. It becomes a processing fee, even if it is, say, 10 rupees that he's paying you for that. If you take it from an IRR perspective, you'll say, "Oh, what is this? This is." But the problem for him is not the 10 rupees. The problem for him is that he will have to either go to the bank or speak to somebody out there or call up somebody else and say, "Hey, look, just arrange for that 1 lakh rupees here because the distributor is going to come at 11 o'clock. And if I don't pay him, he will not supply to me in the evening because there is a launch happening of a Vivo V7 product and I need 3 units of that."
It's clear.
Right.
So thanks for that, Rajiv. I think let me come to Arpit. Arpit, you come from completely different. I mean, Rajiv focus on payment side. Arpit, you come from a completely different, more from an enabler kind of perspective. Where do you see the largest opportunity? And let me maybe SME he covered already. Maybe retail, if you can cover a bit in terms of where do you see the largest opportunity for fintechs going forward?
One, that distinction is important. I think when we say fintech, that there are like two large words. Of course, there are multiple pillars, but there are two large words. One are companies which are doing finance but using a lot of tech, like Vasu, and then there are companies which are uh, doing tech and just servicing financial institutions like us, Perfuse and Innovity. So and both have different set of opportunities, right? If you look at the first one, you will have to discover where there's inefficiency, right? I mean, years ago, payments was very inefficient, and you saw like a bunch of payment companies coming in, and then there was wealth. Wealth is now solved. Wealth, I mean, but wealth keeps. I mean, there are more and more that you can do in wealth, because if you even look today, most of us, including someone like me who's into tech, we all feel that we are not making enough returns that we should make. Everyone feels that, right? And that generates demand. That generates a demand that someone wants to. I don't see that kind of demand for insurance. I've not come across people saying that I want to be insured. Of course, there's a compulsory insurance that you need to take for your vehicle and sometimes in your business. But apart from that compulsion of insurance, you generally don't find, even though there's so many ads on life insurance, I mean, that compulsion does not exist, but it exists in wealth. And hence you see the amount of demand. And if you see the new age, I mean, most of us were on SIPs because we had salaries. If you look at the next generation, most of them are entrepreneurs. Most of them don't do jobs; they either do reels or, so most of them are entrepreneurs. They're self hired professionals, and they do not have regular incomes. And you will see different kind of personal wealth products that will be needed to service such kind of next generation of people who will have a lot of money, but our traditional SIP kind of products might not work for them. So I do see that wealth is a very, very large opportunity in this country, because we are one of the fastest growing economies in the world. While we say that our per capita income is low, but it's the fastest growing per capita income. I mean, the parity still remains high, but if you see, the more people have become millionaires in this country than anywhere in the world in the last few years. So you're seeing more people acquire more and more wealth, and everyone will eventually start feeling that I'm not doing enough with my cash flows. I'm not earning enough interest, and that will create huge demand for wealth players, which you are seeing even today, by the way. But today, if you look at most wealth players, they are into simple brokering. You still haven't. A lot of them are trying advisory, but it's so. So I do believe wealth is going to be one of the largest, finance sector in India, which is going to play out. And there, I think fintechs will have been doing better traditionally. If you look at it, like if you look at lending, banks are better than most fintechs today, right? They have larger books, they have larger profits. But in wealth, it's exactly the opposite. The fintechs are much better than the traditional players. So I think that is where a very, very large opportunity for fintechs will exist. And if you look at the second sector, which is tech fin, which is the technology providers to finance, I believe there are two large themes if you look at in India and even globally. We have digitized very fast in the last 10 years, right? Which has created new types of infrastructure. It has created new types of ways of communicating, ways of payments, and it has created a new problem of digital fraud, which the world did not see 10 years ago. And most of the systems which are built to combat fraud did not imagine the world in the way it works today. And you couple that with AI, I think this problem is multifold. So I do believe in the tech fin space, while a lot of focus last 10 years was user experience, right? We wanted to get faster onboarding, we wanted to do faster underwriting, we wanted to have the fastest journey for the customer. And if you look at all themes, everything was about fast, simple. I think a lot now is going to be about security. Going forward, a lot of technology which is getting into banks from outside is going to talk more and more about how do I help you combat fraud? How do I help you ensure that AI is not going to do a run through on your system? And that and why I feel why is that something the banks would not do on their own is because I feel that it's a very specialized field that's going to emerge, and no single bank may have the resources to do it on their own, and they will look for specialists to do it. So these two I see as very large opportunities in fintech in the next decade.
Yeah, thanks. Thank you so much, Arpit. I think the point you raised about we can't look at all fintechs in one lens because each vertical is very different. That's a good segue to my next discussion I wanted to have. I think let's take the lending as a segment because lending is again one of the areas which is critical for boosting our economy as well, and that's where a lot of challenge exists today in terms of under penetration. Maybe I'll come to Sabia first. I think if you look at it in the past few years, there are enough examples in the fintech ecosystem where unsecured lending has been solved. So there are large NBFCs or large fintech NBFCs who are doing fairly good in terms of both scale as well as profitability on that front. Now, if I look at secured lending, there are hardly any of them who can say that okay, they really build scale in terms of lending, right? So, just want to understand what's the structural challenge in terms of building a secured lending, like for example, a home loan or a vehicle loan or whichever you take, gold loan, whichever you take. What stops fintechs from building a business model which is scalable in these segments?
So, a couple of things, but again, first, because I represent TechFin here, so some of the myths I want to dispel. I mean, technology is not the barrier, actually, the process integration is. And that's a very big gap that I feel, and that myth has to be dispelled. When I say the integration, if you look at secured, and I think again the morning distinguished guest was discussing on that, and just before we came up, we were discussing in the room that when you talk of secured, is it truly completely digital from end to end? The answer is no. You still have physical elements to it, attached to it. And when you talk about fintechs who are on the lending space, if you have to operate in a model that they have built, which is largely end to end digital, secured truly is not, because you still have the physical verifications slash validations happening. You have the legal technical which is happening. The records, as we say 22 states are digitized. I'm sorry to say that's not the truth. So few people may disagree with that, but because we are in that space, I can claim that with certain certainty, because when I pull the records, it is not complete so as to assess and make a decision. So when we say we are truly digital as a country also, it comes with a lot of ifs. And we need to appreciate that. If we appreciate that, that means you can only get into secured lending if you are able to bridge that process gap in terms of that it will be physical plus digital. It is not truly digital today, which fintechs have shied away. This is the first part. The second part, which is we have to appreciate, when you talk of secured lending, any kind of secured product, it's very capital intensive, unlike unsecured. I'm not saying unsecured is not requiring capital, but what is the tenor of a loan in unsecured? I mean, let's take a home loan or a LAP or something like that. Usually 10 to 15 years, at least average 15 years. That means your capital requirement is for that long. So structurally, I feel the answer to that is probably a better co-lending, and regulators have taken notice to that, and I think there are certain early signs of reform. I'm not saying that we have arrived there. It will take some more iterations, but that's the right beginning. So I think that's a structural shift which is required. The third important part in secured in any space in financial services is the basic word is trust. Now, for a fintech to build a trust on ground, because it is physical and you need a longevity of 15, 20 years for that product to sustain and the capability to service, that means you need to also have some branch-led model, or at least you need to win over the trust, which will not come overnight or in 18, 24 months, which usually in unsecured is relatively low intensity than in secured. So I say these are three key structural shift. If we see in our model, then probably this is the best thing to happen, because we need to look at secured because it is more sustainable, and because we started with the theme profitable and scalable and sustainable, I think you can't avoid the product lens of secured.
Clear. Vasu, let me come to you. If I'm a fintech today, I have two, there's a fork in the road. One is there's a lot of under penetration opportunity in tier 3, 2, 3, 4 markets, etc. The other option is there are many global markets where there's large opportunity for Indian fintechs because Indian fintechs are mature compared to many other countries globally, right? So if from your vantage point, uh, what should be a roadmap for a fintech in India? Should they look at both? Should I look at only India, or what's the right answer in your view? Because the reason I'm asking is both helps you build scale, right? You can build scale in India, you can build scale outside. So what's the? I mean, I know there is no
Yeah.
beyond a there's no right answer, but
No,
what's your
I
perspective?
think there's no easy answer, and you also said, I think there's no absolute right answer. It fundamentally, I think, two drivers. If one had to make a decision point, it goes back, I think, to philosophy and culture of the business and the people who are building it, capital availability to it, and I tell you why. If you were to distinguish between these two aspects, going international, if you do not have deep pockets, it's perhaps not worth the experiment because you're going to. Tier 2, tier 3 is going to be about sustenance and resilience and wanting to re-architect many things as you go along. So the decision making will lie. Can a company kind of straddle both those parts? Constructionally, it's always going to be arguable saying you create kind of two SBUs and they look at it. But top management, attention wise and focus on calls that you have to make, at the pace at which innovation is happening, you perhaps better yield or ROI from a decision making perspective, capital is going to be focus. But if I have 30 seconds, I want to go back to some of the earlier discussions, which I think, while it's not part of the question, one of the fundamental things I think when we think of India, opportunity, MSME, to the point that Arpit made, he made a very valid point, and I kind of married to the earlier points. A lot of India has been about what India is told it needs to do. Capital came in easy and said, grow, grow, grow. You have the demographic profile. People said, I'll reward you if you're fast, fast, fast. And therefore it's grown. So in a sense, perhaps the opportunity is to look at what India needs versus what India is told we're doing. And that's been a significant drive, at least for fintech space. I think a point which will be perhaps controversial, won't have many bias, but I think one of the significant aspects underestimated by all decision making, which is typically metro-centric, is to underestimate how India as a customer behaves, the socio-economic impacts. So when we talk of, let us say, MSME, I do have a controversial point of view that MSMEs survive because there is inefficiency that is there. You make everything very efficient, select MSMEs will survive. And one last note on that, and that perhaps explains why today there's a discussion paper regulator puts out saying, in a world that is looking at faster payment, should India explore delayed payments, right?
Yeah.
I think.
Thank you, Vasu, for that. One of the things, Sabir, you mentioned, the whole digital model part of it. One of the ways fintechs have been able to at least do successfully by intermediating the entire distribution is by looking at embedded finance, right? Rajiv, maybe I'll come to you on this. What kind of models have you seen work in embedded finance? Because again, the question is scale, right? There are BNPL kind of models which have worked, but beyond that, we don't have examples of successful embedded finance happening in India. So, any light on what kind of models you have seen? What have you tried? What works? What doesn't work? Any thoughts on that?
Yep, no, absolutely. I think embedded finance, again, the point that Vasu was raising, if you just keep looking at, okay, what has worked abroad and just bring it here and say, let's apply it in the middle context, just doesn't work in the Indian context. You have to think about it very differently. What we have seen work from a direct perspective is, for example, simple things like in the flow of the transaction, if the consumer has a choice of paying now or being able to convert that into installments, definitely works. If you convert embedded finance into a sales acceleration mechanism for the merchant or for the brand that the merchant is selling, which is, for example, the entire brand offers led piece, which is a massive piece in the country today. It's more than 1 lakh crores of brand financing that happens. It works. It works brilliantly. It's meaning it's not that it doesn't happen in the secured lending point. It happens in, for example, in automotive. It happens in two wheelers. But in I'm talking about unsecured lending. I'm talking about embedded, so that is happening at the point of transaction when the consumer is checking out. It absolutely works. If you go to the B2B side, I think the example that I was giving earlier, we have seen it work. Meaning we have been surprised that more than 80% of that volume that we are seeing in the SMB, the merchant at least 3 times a month decides to take a call of instant settlements, right? And it's embedded because he has done these transactions. He just did not plan it. Somebody came in the afternoon at 3 o'clock, the distributor. He said, "You had promised me yesterday. I came again. I need that money out here." He has to buy stock out there. He needs access to cash. It's not easy for him to get access to cash at that point in time. Can he it has to be again embedded. It has in a part of his payment flow. Can he now get access to this cash? Works, absolutely works. So I think again, it's very particular to the industry. The whole brand-led financing has been very successful in the electronics category. It has been successful to a certain extent in the automotive category. Works there. It's very particular to how trade is structured in India. How trade also happens in India, right? India is very different. I mean, we had, for example, for a short while, we had experimented with that through some partners in the West. The structure is very different. You have exclusive concepts there. You have multi-brand concepts here. You have the distribution is 3 or 4 layered. When the distribution is so deep into the country, financing starts becoming more and more important. Virtually 80% of all B2B transactions happen on credit, right? So, but again, building it into the flow. So works. And fintechs have done a reasonable job there. But again, think of it from the Indian perspective.
Yeah.
Don't think of it in general.
Thanks, Rajiv. I think I'll take 2 moments. We've been asked to close, but no discussion is complete without an AI discussion these days. So maybe let me go to Arpit. Arpit, all of us know that AI has been disrupting every company in financial services today, whether it's a bank, NBFC, whichever company you take, which raises an uncomfortable question for fintechs. If let's say a bank or NBFC can use AI to fast track development, fast track solutioning, product design, etc., that in some sense takes away some of the moat which or the USP of fintechs in some sense. So how do you see fintechs? What's the outlook for fintechs in this era? Is it like it's going to help fintechs become better at what they do, or do you see them being threatened by the incumbents going forward? Maybe 2 minutes, and then we'll
No,
close.
I think that's a very good question. I'll do a quick one. So, one, I feel that banks were never short of talent or resources. Bank always had larger capital. They always had larger resources. So, if you think about building a house, if you have brick and cement, that does not guarantee you build a good house, right? It's the architect. And I think what fintech did really well is they architected using the technology, beautiful products, better user experience. And in that, I think that's exactly what's going to happen with AI. In fact, if you see fintechs are delivering far more using AI than any bank as of today. If in fact it's going to be the reverse, right? The big advantage banks had today was that they had huge call centers, they had huge teams which could do collections, which fintechs did not have, right? Now a 10 people fintech team can also call 1,000 borrowers who had to collect back the money. So in fact, if you see that now a lending fintech has that advantage which a bank had, or they can call so many, like Bajaj, for example, right? Bajaj themselves are saying that so many loans are now booked using purely AI. So if you see that fintechs who are going to architect well are going to see this advantage. But techfin is yes. I mean, the techfins are going to see, I think, some impact because a lot of work that techfins were doing for the bank involved technology which banks can now do using AI. And that much impact, I think, techfin are going to see for sure.
Got it. Thanks, everyone. I think thanks to all the panelists as well as the entire delegates for being a great audience. Thank you so much.